Good morning. The Federal Reserve just cut interest rates for the first time in nearly a year, a move that directly impacts your wallet. Interest rates are the cost of borrowing money. When the Fed cuts rates, it's trying to make loans cheaper for businesses and consumers, hoping to boost the economy. The main reason? Job growth has slowed and unemployment is at its highest in 4 years. Fed Chair Jerome Powell says risks to employment are rising, so the Fed is acting early to prevent bigger problems. But the decision wasn't unanimous. Some officials wanted a bigger cut, while others think no more cuts are needed this year. This division shows just how uncertain the economic outlook is. The Fed's goal is a soft landing, cooling inflation without causing a recession. It's a tough balancing act. So what does this mean for you? A rate cut doesn't always mean your mortgage or credit card rates will drop right away. Sometimes rates on loans can even rise in the short term, as we saw with mortgages after the announcement. The bigger story is what this signals. The Fed sees warning signs and is taking action. Understanding these moves helps you make smarter decisions with your money. The rate cut is just one step in a much longer journey for the economy. Stay tuned. How the Fed acts next could affect your finances for years to come. The key takeaway: pay attention to these changes because they shape your financial future. We'll break down what comes next. Let's talk about the US dollar and how the Fed's rate cut affects its value. Lower interest rates make the dollar less attractive to foreign investors, so many start selling dollars for better returns elsewhere. This increases the supply of dollars globally, causing its value to drop. A weaker dollar means it takes more dollars to buy imported goods, so prices rise. That's inflation. Your money doesn't go as far as it used to. We're already seeing this. Your savings buy less than they did just a few years ago. The recent rate cut could speed up this trend, making everyday items more expensive. The Fed is in a tough spot. It wants to boost the economy, but cutting rates can fuel the very inflation it's trying to fight. For families, this means budgeting gets harder as prices rise and savings lose value. The money you've set aside for retirement or big purchases may not stretch as far in the future. That's why it's crucial to understand how interest rates, the dollar, and inflation are connected. These forces shape your financial well-being every day. The bottom line: your money's value is under pressure, and you need to plan accordingly. Stay informed so you can make smart choices. Inflation isn't just a headline. It's something you feel at the store, the gas pump, and in your bank account. We'll show you how to protect yourself. It's not just individuals reacting to the Fed's rate cut. Countries are making big moves too. For decades, the US dollar was the world's main reserve currency, but that's changing. Central banks in countries like China and Japan are selling off their US dollar holdings, especially as the dollar weakens. Instead, they're buying gold at record levels. This year is set to continue that trend. Why gold? It's a universal store of value, not tied to any one country's policies or politics. When there's economic uncertainty, gold is seen as a safe haven. As countries sell dollars, those dollars return to the US, increasing our money supply. More dollars chasing the same goods means more inflation here at home. This global shift is historic. The world is moving away from the dollar, challenging America's economic dominance. As more countries diversify into gold, it signals a loss of confidence in the long-term stability of the US economy. This isn't just a financial story. It affects every American's financial security. The flood of returning dollars adds to inflationary pressures the Fed is already struggling to control. The world's vote of no confidence in the dollar has real consequences for your savings. Understanding this trend helps you see why gold is becoming more important globally. The financial landscape is shifting and it's happening fast. We'll explore what this means for your investments. Stay with us. You've probably heard the term stagflation, and it's back in the conversation for good reason. Stagflation is when the economy slows or shrinks while prices keep rising, a double hit to families. Normally, high unemployment means lower prices, but stagflation means both go up, squeezing budgets. The Fed is trapped. Cutting rates to help jobs can make inflation worse, but raising rates to fight inflation can hurt jobs. Many economists say, outside of the booming AI sector, the US economy is already showing signs of recession. Weak job numbers and stubborn inflation are a classic setup for stagflation. The last time this happened, in the 1970s, it took years and painful policies to fix. The fear now is that the Fed's rate cut could lock us into this difficult pattern. For families, it means rising costs and fewer job opportunities. It's a high-stakes gamble with our economic future. Understanding stagflation helps you prepare for what could come next. We'll show you how to navigate it. Looming over everything is America's national debt, now at a staggering $37 trillion. That's up from $8 trillion in 2008, and it's growing fast. The biggest problem? The interest payments, over $1 trillion a year, second only to Social Security. That's money that could go to infrastructure or healthcare, but instead just pays for past borrowing. To cover these costs, the government often prints more money, which devalues every dollar in your wallet. This is a direct driver of inflation, a hidden tax on your savings. The debt is now so large that paying it back through normal means seems impossible. This forces more money printing, guaranteeing the dollar will keep losing value. Other countries see this and are losing faith in the dollar, turning to assets like gold. The debt isn't just a Washington problem, it threatens your financial stability. Understanding the debt crisis is key to protecting your wealth. We'll discuss what you can do. Beyond inflation, there's another revolution. Artificial intelligence is transforming the job market. AI isn't just in factories, it's writing articles, analyzing legal documents, and even running tractors. This wave of automation is disrupting both blue-collar and white-collar jobs. The fear is real. Many jobs could disappear, adding pressure to an already fragile job market. So, which jobs are safer? Experts say hands-on trades, critical thinking, and roles needing a human touch are more resilient. Plumbers, electricians, and nurses, jobs that require real-world problem-solving, are harder for AI to replace. For those entering the workforce or considering a change, skilled trades may offer more stability. Adapting to this new reality is key. AI can be an opportunity if you focus on skills that are uniquely human: creativity, empathy, and expertise. The future belongs to those who prepare and adapt. Don't fear the change, use it to your advantage. We'll help you get ready. With all this uncertainty, where's the smart money going? Big banks and central banks are betting on precious metals. Goldman Sachs, Bank of America, and JP Morgan are all predicting record highs for gold. Some say up to $6,000 an ounce. Their reasoning massive U.S. debt and a weakening dollar make gold a safe haven. There's a strong historical link between rising government debt and rising gold prices. But it's not just gold. Silver is also in the spotlight. Silver is both an investment and a critical industrial metal, used in solar panels, EV batteries, and electronics. Demand for silver is soaring, but its price is still considered undervalued compared to gold. Some analysts say silver could rise dramatically just to reach its historical average ratio with gold. This mix of high demand and its role as a monetary metal makes silver a major opportunity. Investors are watching both metals closely as the financial system shifts. Precious metals are becoming a key part of smart portfolios. We'll show you how to get started. With so much economic uncertainty, how can you protect your savings? First, get educated. Understand inflation, interest rates, and the national debt. Don't let your money sit idle in a savings account losing value to inflation. Diversify your assets. Don't put all your eggs in one basket. Consider stocks, real estate, and, as we've discussed, gold and silver. Precious metals have a long history of preserving wealth during currency crises. Even a small amount can act as financial insurance. Create a plan that fits your needs and risk tolerance. Talk to a trusted financial advisor if you need help. The goal isn't to panic, but to be proactive. By diversifying, you can protect your wealth from inflation's silent tax. Take control of your financial future, no matter what the economy does. We'll guide you through your options. We've covered a lot, from rate cuts to gold rushes and the changing workforce. The financial system is shifting and the value of your money is under pressure. Domestically, rate cuts and money printing fuel inflation. Globally, countries are moving away from the dollar. These are big, long-term changes that will affect your finances for years. Now is the time for diligence. Pay down high-interest debt, build an emergency fund, and think carefully about where you keep your savings. Diversify into assets that hold value: real estate, quality stocks, and precious metals. The key is to be informed, have a plan, and take action. The world is changing, but you don't have to be a victim. Smart, proactive decisions can help you thrive, not just survive. Stay prepared, stay informed, and face the future with confidence. We'll keep you updated as things evolve. Thanks for watching. Take care.